Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Today we're going to look at Estee Lauder. Behind me is their 10K ending June 30th, 2019. Their fiscal year ends in June, so it's a little out of date. We're about 9 months behind. A new one should come out here in another 4 months. So we'll take this, we'll update it a little bit, and then look forward to see what we think this stock could be worth. All right. I would encourage you to read the 10K. In there, it's going to give you a tremendous amount of information for their company, and it's very important when making an investment decision. What you'll learn is they're a brand company. They own a tremendous amount of makeup companies, makeup and fragrance companies, names that you will absolutely recognize, like, of course, Estee Lauder or Clinique, but also new ones like Smashbox and Too Faced. Very important to position themselves as a brand company. It's how they charge a premium for their product. And I think it's what gives them staying power in economic times like these. So let's zip forward. We're going to look at 10 years of financial information and then come up with what we think a value of the company might be. We're going to do this with 5 key attributes that we look for in a profitable investment. And that would be top-line revenue growth, earnings growth as we define it by EBITDA, free cash flow growth, strong balance sheet, and well-priced stock. Let's go right into the EBITDA numbers. So behind me you'll see 10 years of financials. You'll notice strong revenue growth is the very first thing. It starts at $7.3 billion 10 years ago and goes all the way up to $14 billion last year. This is largely done through acquisitions. They have bought 5 different companies in the last 2 years that have led them to be able to grow, including the most recent one of Too Faced of $1.5 billion, which is the largest to date. Now, they've made acquisitions throughout their maybe 20, 30 years, so they are accustomed to buying brands and folding them into their infrastructure. And it's nice to know that they've been doing it that long. They could take on a large acquisition like Too Faced and be able to integrate it properly. Well, let's continue through the EBITDA calculations. We've got operating profit. I'm pulling directly from their income statement. You can find that on F6 in their 10K. Adding back amortization, adjusting for one-time items. These are mainly goodwill impairments that are associated with changes in value of the acquired company. They're not great. You would generally not want to see any of these, but making lots of acquisitions, it's tough to get everything right all the time. And they're basically expenses to bring the purchase price in line with what they actually received. What I will note, it's a good thing that they are small. This is roughly 1% of the EBITDA. If it gets 10, 20, 50% of EBITDA, that's a problem, and it's a management responsibility, and we would hit EBITDA, we would not add them back. But in this case, I'm adding it back to make it simple. And you get a growth rate of EBITDA, 21% over the last decade, fantastic. Recently, they've been at 17 and 15% growth, which is also nice to see. It sounds like those acquisitions they made during this period of time are really paying off in 19. Let's go forward and get the total enterprise value number. We're going to pick up with growth. They do have a pension. We'll pick up with debt. They have a pension, so I've added that liability in here. But it's reasonable. From 2.6 billion to 4.6 billion of total debt. Cash on hand was nice. They ended the fiscal year with nearly $3 billion of cash on hand. This is only the excess cash that I've kind of arbitrarily determined to be excess. Market cap, that's share price times shares outstanding. Add it all up, minus the cash, gives you enterprise value. Again, enterprise value is the entire enterprise if you wanted to buy it in cash. We look at investments as though you buy them lock, stock, and barrel, and you own the whole thing as though it's private. It's the way professional money managers look at it, it's the way professional private equity people look at it, and it's the way you should really look at it as a single investor. It'll help frame your value decision on whether you want to buy it. And hopefully, it means you're going to hold it for long and not try to flip it in and out and make a quick buck. This is long-term investing. EBITDA multiple, it shows you the range in which they traded. Everything from a low of 12.5 all the way to a high of 23. They've traded pretty high recently. I think that's on the back of the acquisitions they have been making, which is fueling growth, which is expanding the multiples that they trade at. Debt's been very, very manageable. 1 to 1.5 times EBITDA of debt is very nice. That's what we like to see. And certainly if you're going for protection, as we define it, the strong balance sheet being low debt and a good cash position, I think this checks that box. On that note, it also checks the revenue growth and EBITDA growth box, which are both very strong. All right, let's go look at free cash flow, and then we'll forecast value after we look at free cash flow. So again, free cash flow, I'm pulling that off of the cash flow statement, which is F10 on their financials. And we're going to begin that with cash flow from operations. The cash flow from operations is about a third of the way down the cash flow statement. And it is the cash money that they generate from selling their makeup, making makeup and selling makeup, and fragrances and their hair products. What we have to do is we have to then subtract the cash they need to reinvest in the business. That comes from property, plant, and equipment, about halfway through the cash flow statement. And that's roughly, last year, $744 million, as compared to the $2.5 billion that they generated in cash. And this is important. You like to see this, where cash flow from operations is much bigger than what they have to reinvest in the company. That's good. That means there's more cash available for debt service and more cash available to pay you and I, shareholders, which is what value is based on. In this instance, their debt payment was relatively small, $172 million, which means most of this free cash flow passed right through to the equity holders, which is what we want. $1.6 billion, shares outstanding, gives me a free cash flow equity per share of $4.40. You can see that has grown over time. Recently it's come down. It might be as a result of some of the acquisitions that they have done to try to reinvest in those a little bit, get them folded into the enterprise. But if that holds true, that should kind of normalize or grow, and that's going to be good for everyone. The share price outstanding over time, and then the yield. Again, I'm dividing the free cash flow to equity per share divided by the stock price gives me a yield. 4.2% is the average. We're going to use this when we forecast the value. And the growth rate of that free cash flow is 23%. It's good to note this 23% growth is very close to the EBITDA growth. That means cash flow and earnings are going in the right direction, right? They're very similar. If they start going in different ways, you have a problem, and it could be an accounting issue. So you want to be very careful about that. But this looks good. Now let's forecast forward. Let's forecast forward the free cash flow, and let's forecast forward EBITDA and come up with valuations. Okay, so let's forecast the future value of stock based on free cash flow to equity holder per share. We're going to pick up next year's estimate at 5.16. Now that is going to be high. No doubt the coronavirus is going to hurt these guys. They have a lot of exposure to travel, to airports where they sell their makeup in the duty-free shops. So I would expect this to be a wild miss. The point here is over the decade, because we're concerned about long-term, over the decade, they need to average 15% growth off of last year's $4.40. Now that's 15% growth. The previous decade, they grew at 23%. So I'm haircutting growth. And I still think it's reasonable that they can do it. Certainly when they're buying other activities, they have plenty of cash flow to go do it. If they execute this, they will have $17.78 of free cash flow to equities. I'll use the yield that we calculated before, the average yield, 4.2. Divide the two, and I get a stock price estimate of $418 in 2029. Okay, so call it $420 a decade from now. Let's do the same thing with EBITDA. If I zip down to EBITDA, again, picking up EBITDA off the previous EBITDA, forecasting it forward, I'm saying it's going to grow 16% year over year. That's going to be wrong. They're going to have more costs. Over time, though, I need 13.7 and 14%, roughly the 15% over time. And again, that's less than the EBITDA had been growing in the past decade, so I'm okay with that. That puts an EBITDA target at $10.6 billion. I'm using an EBITDA multiple that they've achieved over time, the average of 18.7, and I get an enterprise value of just shy of $200 billion. less some debt on the assumption and cash gives me a market cap of $187 billion, divided by shares outstanding currently fully diluted, gives me a share price of $507. Outstanding. Now we have two estimates for value. We have one based on free cash flow, and we have another market multiple approach based on EBITDA multiples. We have two different ways of looking at how the market treats it and how free cash flow treats it. Two different measures. We're going to average the two to come to a single price. So here you go. Single price. There's the free cash flow equity, 418. Here's the EBITDA market multiple approach, 507. Average to $462. It's trading at $164 as of today. So that's a solid difference between the 160 and the 462. Let's put that into an IRR and see where it stacks up. All right. Here's our free cash flow equity. Again, this is just a guess annually based on the cash that they generate. I've got an investment of $164 that they would invest, and then I'm going to grow that over time at a discount, and I will get $480, excuse me, when I sell out 10 years from now. Now, discounting that all back at an IRR is 17%. That means it's an annualized rate of return over time. Every year, you should be getting 17% of your money, on your money, as it builds. If I break that down a little further, you get $106 from essentially dividend. If they took that free cash flow and they dividend all of it out. Now, that's not the dividend that they currently pay, because they take some of that, they reinvest it for growth, but assuming they kicked it all out, that's what they would have. And then the stock gain itself, just under $300 for a $405 total gain. That is in itself 3.5% cash on cash. So I put in $1, I get $3.50 back at the end of the decade. Solid numbers. So let's go over our five characters. Revenue growth, check. Earnings growth by EBITDA, check. Free cash flow growth, check. Strong balance sheet, yes. Well priced, it looks like it, 17%. If you're comfortable with that, that's a good entrance point. Who knows? It could go down from here, it could go up from here, nobody knows. But 17% IRR over a decade is slightly higher than this general S&P 500 does, and it's a very good, in my opinion, very good risk-adjusted rate of return. All right. My name is Cameron Stewart, CFA. This is a review of Estee Lauder. Thank you very much for joining. Have a great day. Bye-bye.